Good day, fellow investors. JD Stock Analysis. This Monday I asked in the community tab which of the 5 e-commerce stocks from China you would like to see analyzed, and more than 4,500 votes said JD. So 60% of those for JD. That's always interesting, always focused on the bigger players, while the real investing opportunities might be with the smaller players. Nevertheless, let's discuss JD, and I'll try to give an overview of the key things that one has to think about when it comes to investing in JD. So if you enjoyed this video, if you get value from this, please smash that like button. We'll start with the stock price overview, the listing issues and everything, fundamental business overview. We'll make a usual stock valuation for JD, and you will see how those inputs might fit your investing risk and reward. And then we'll conclude with an investment thesis. Let's start. So JD e-commerce stock really again exploded after COVID, as what was planned that will happen, disruption in the market over the next decade, happened in just a year. However, sentiment towards Chinese stocks has really dipped in the last few months. And these dips, when the underlying businesses keep growing but the market doesn't like it, or who knows what, create often really great investment opportunities. And there are a few things that one has to think about when it comes to the stock. If I read the comments, and if you read the comments here, there will be a lot of discussion about the variable interest entity structure, because JD is a Cayman Island entity and it has a contractual agreement with the JD.com in China, because you as a foreigner are not allowed to own things in China. And then people say, what if China prohibits it, etc, etc. I would like to do a Charlie Munger inversion here. Okay, these are contractual agreements. If China prohibits these agreements, then China is practically nullifying all the legal agreements that China has with the rest of the world. If that happens, that simply would create so much distraction, both in China. China would end up a lot poorer, and so much destruction in the world that you would not care about your stock market portfolio. You would care about finding things to eat, medicines, etc, etc. So from that perspective, it's really unlikely that China would do something like that, because it would simply lower the wealth of the complete world, which is not rational. And the Chinese are doing things pretty rational, especially over the last years. Plus, they are really investing into finances, into expanding, opening up, which is very interesting to follow, not the headlines, but the real situation there. And they are doing a lot of legal things that also help with the businesses there. The second thing there is the delisting from the US because of the US laws. And that might happen, but then again, why would they do that? Because JP Morgan would make much less money, things like that. Capital would flow from New York Stock Exchange to Hong Kong, so there will see some balances, but in any case, every company has 3 years to reach the standard, so there will likely be a deal. And even if it gets delisted, you can still own it in Hong Kong, you can exchange it, you can sell it, you can buy it there, so not really a big issue there. Let's go on the business. It's an e-commerce, logistic and omni-channeling platform, growing really fast, especially over the last years. It is the dominant retailer in China. It is an asset-heavy business model. They buy the inventory, they have the logistics, they own everything in that chain, not just a platform. So that's why the margins are thin, and they are also investing big into JD Logistics, where they want to build a network of logistic hubs across China to really dominate also their own scale in the future. Retail was really growing fast. JD Logistics even faster over the last 12 months, and new businesses are exploding too. So all looks good there from a business perspective with JD, but the market is a little bit turning negative. And JD's core business retail advantage is what they say, that they have a 5 percentage point margin advantage compared to other retailers like Costco, Walmart. 5% in retail is not big, it's huge, is insane. And if they can reach that margin, and we'll discuss that later in the margin section, in the next 5 years on huge scale, it will be extremely profitable. And they want to improve the profitability with scale. They are now at around 2% in good times. If they can scale further and they can charge on that advantage, some say they will reach a 6% profit margin, but even if we are more conservative at 4 on improvements, that's still really remarkable. Plus they own a lot of other businesses, JD Logistics, JD Health, JD Properties, DADA, the last mile delivery system that they are trying to incorporate with other businesses and really scale them individually. You can buy also the stock here. But this is the core, the network, the last mile reach, the customer service that they really did well there. Of course, the market is also still growing fast, still big development, middle class expanding, so there is still a lot of room to grow for JD despite the competition being there too. But as everything is growing, therefore also JD with its scale is growing faster than the market and will likely continue to do so down the road. However, there are also some risks. I've just analyzed Pinduoduo, and Pinduoduo says that conditions are ripe to reimagine logistics. So they are doing it in agriculture, they are doing it with their platform. They want to cut out the middleman, which in this case is JD. So that's a threat, but I wouldn't say a threat because the market is growing so fast that both this can be achievable alongside this. So it's likely that we'll see these players, both players, surviving over the long term. On the fundamentals, you have to keep in mind the business model here. It's a negative working capital business model because when you buy something online, you pay immediately, but JD and others pay the suppliers 45 days down the road. So they have, let's say, a month and a half of cash that they can use, like float, like Warren Buffett does, at their will. So they can issue a little bit of shares to get billions that they can reinvest. So I don't think there are any fundamental concerns with JD. Now, if I go to my stock market comparative table, I have put both JD and Pinduoduo on my following list. I will make more analysis. I'm currently digging deeper into the sector, and this is my valuation table for JD. I have started with net income here, so 1.9 billion adjusted for the asset balances there as their listed companies increased in value, so don't count that into net income. But if I assume a growth rate of 20% of net income on 15% revenue growth, this is perhaps a little bit more conservative, but okay, let's just take conservative. And then a 20 terminal multiple, this is in billions, the intrinsic value is 57 billion with a very conservative approach, keep in mind. If we compare to the market capitalization, let's say overvalued by 50%, but let's change things a little bit. Net income and growing at 25% rate because the margin expands from 2 to 4%, so that's 15% revenue growth, and then even faster margin and net profit growth as they scale, as they become more profitable. And then a terminal multiple of 25 for such a strong and good business, and then you're already above the current market valuation, 115 billion compared to 111 billion. So you are, let's say, fairly priced for a stock market return of 10%. Plus, I'm not including JD Logistics here. Huge value, but it's not profitable. So when you put it in a model, it gives you zero value. That's just what you get from free. JD Health, DADA, and all the other businesses that are growing fast have huge potential are not included. You can download my template, you can put in your own numbers, the link is in the description below, and you can see whether other inputs are better, you think I'm wrong somewhere, I'm definitely wrong. It's always predicting about the future, which is difficult, but it's an interesting game to see, okay, this is JD, how does it compare to other investments out there? And let's do a Charlie Munger thing and invert. Let's not think about how much money we can make with JD, but let's start thinking about whether we can lose money by investing in JD. And when you start inverting and you start thinking, okay, what's the margin of safety, then everything becomes different when it comes to investing. And I really hope I can give you value with a different perspective here. If we start thinking about, okay, the current market cap is 110 billion. In my very, very conservative estimation, the terminal value, the market cap, will likely be 150 billion 10 years down the road, without including the other things, so without including the new businesses. So it's very unlikely that you will lose money down the road by investing in JD, which is a huge investment quality of a business. It is creating scale. It is creating the distribution out there that it's unmatched in China. It's still not profitable, but growing fast, and one day they might scale on it. They already said we will start lowering the reinvestments, but down the road the profits should go up. There is always competition, but you have this underlying very, very strong trend, which is the key when it comes to investing. Even if you make mistakes, if the market grows, as Buffett says, you will do well. So I don't think there is a big chance of losing money long term. Volatility, of course, anything can happen. Short term, the upside in the better case scenario is really you can 3x your money easily, perhaps even more down the road. So that is something to keep in mind when it comes to investing. Of course, nobody knows what will happen in the short term. The investment depends on the cycle. 2021 was a really good year for e-commerce. That's something to keep in mind. The margin power, if they can really turn the scale they are having into profitability, that's something to watch. And then also the sentiment. Where will the stock go? I'm looking into the sector now because I'm feeling negative sentiment. You will see in the comments with China a lot of negative sentiment, which might create an opportunity. And I'm looking for, of course, if it goes down 30–40% more, it will become just more interesting. Morningstar has it fairly valued, what is this, 40% upside, as they expect that they will do really well over time. And the key to watch are these margins. The operating margins were really sacrificed as they were scaling. Now they have already 500 million active buyers over the year, and China is still developing. So if this can get from 1.6 to 5, 6, 4, then profitability will explode. And then you have already a great business. If they can turn this $2 billion into $10–20 billion, compare that to the market cap of $100 billion, plus the growth potential, and you have a great investment. So great business, still growing, building something in China, that's the value of it. There is a lot of potential for profitability, potential with the new businesses out there. And then you have to see, okay, what is the risk, how much to allocate of your portfolio. And keep in mind, it will be always a volatile stock in a cyclical, let's say, environment, exuberance online, then a little bit lower, depending on Chinese economies, depending on the margins and the competition. So that's something to keep in mind. And that's exactly why I'm looking deeper into the sector. I'm looking at all these e-commerce players, understanding how the puzzle works. And that's also what I'll be working on in the next 2 weeks. So we'll see. I'll probably discuss, let's say in 3 weeks, a smaller player to share with you to also close the investment thesis on the e-commerce, but more weeks of work are needed. All in all, I hope I have given you a good overview of JD. Check my stock market research platform overview video if you're interested in knowing more about what I do. Smash that like button, and I'll see you in the next video.